Welcome, dear viewers, to an exhilarating journey into the dynamic world of stock market investing. The prospect might seem daunting, like stepping into a vast, high-energy city where the language, pace, and customs are unfamiliar. You could have heard terrifying tales of people losing their fortunes, or perhaps you're just not sure where to get started. It's perfectly normal to feel a bit overwhelmed initially. The stock market, often painted as a convoluted and high-risk venture, appears to be a private playground for the wealthy or those with financial acumen. But allow us to shatter this illusion. Investing isn't a dice roll, it's a well-planned strategy. It isn't a shortcut to wealth, rather a pathway to steady long-term growth. And without a question, it isn't limited to the upper crust. The cornerstone of successful investing is knowledge. With the right tools and a positive mindset, you can start an investing journey. You don't need a colossal fortune to get going. Understanding the fundamentals and having the courage to take the first leap is all you need. So come along, let's dive right in and break down these. Let's demystify the stock market together and embark on this thrilling journey towards financial growth and independence. To start, we need to understand a key tool of the trade, the candlestick chart. Candlestick charts, originating from Japan over 300 years ago, are a visual representation of price movements in a given time period. They are called candlesticks because of their peculiar shape. A rectangular body with lines stretching out from the top and bottom, resembling a candle with wicks. Each candlestick corresponds to a specific time frame, which could be a minute, an hour, a day, a week, or even a month. The body of the candlestick, the wide part, represents the opening and closing prices for that period. If the body is filled or colored, it means the closing price was lower than the opening price, a bearish signal. If it's empty or a different color, the closing price was higher, a bullish signal. Extending from the body are the wicks or shadows. The upper shadow represents the highest price during the time period, and the lower shadow shows the lowest price. The length of these shadows can provide insights into the trading behavior during the period. So let's break down a single candlestick. Say we have a red or filled candlestick. The top of the body shows the opening price, the bottom shows the closing price. The highest point of the upper wick is the highest price and the lowest point of the lower wick is the lowest price. Now, if we have a green or empty candlestick, it's just the opposite. The top of the body shows the closing price, and the bottom shows the opening price. The color of the candlestick is significant. A filled or red candlestick indicates that the prices have gone down during that period, a bearish trend. An empty or green candlestick indicates the prices have risen, a bullish trend. Learning to read these candlesticks can offer valuable insights into market sentiment and potential reversals in trends. It's like learning a new language, a language of patterns and signals that can guide your investment decisions. With the ability to read candlestick charts, you've taken your first step into the world of investing. Next, we dive into another fundamental concept, trend lines. Now, you might be wondering, what on earth are trend lines? Well, in the simplest terms, trend lines are straight lines drawn on a chart that connect a series of price points. They are like the roadmaps of the financial world, guiding us through the labyrinth of the market's movements. Trend lines serve a crucial purpose in technical analysis, as they help identify the market's direction. Are we in a bull market with prices on an upward trajectory? Or are we in the clutches of a bear market, with prices heading south? Trend lines help us answer these questions. So how do we draw these lines of insight? It's not as complex as you might think. In an uptrend, we draw the trend line along the lowest points or support levels without letting the line cross through prices. This line acts like a floor that prices have difficulty breaking through. In a downtrend, we sketch the trend line along the highest points or resistance levels again, without cutting through prices. This line works like a ceiling that prices struggle to surpass. But why are these support and resistance levels so important? Well, they are like invisible barriers that prices have a hard time crossing. When prices approach these levels, they often bounce back. However, if prices do break through these barriers, it could indicate a significant change in the market's direction. Just remember, trend lines are not absolute predictors of future price movements. They are tools that can help create a clearer picture of the market's behavior. They show us the general direction of price movements and help us spot potential reversals. Remember, the financial market is a dynamic entity. Prices bounce around like hyperactive pinballs, influenced by a myriad of factors. But trend lines, with their simple elegance, can cut through the noise and help us make sense of this chaotic dance. Trend lines provide a glimpse into the market's possible future movement, equipping you with the insight to make informed decisions. So let's keep moving forward and delve deeper into the fascinating world of investment. Now let's tackle the larger picture, the market structure. In the world of investing, recognizing the market structure is akin to understanding the lay of the land. It's about discerning the key features, the highs, the lows, the plains, and the valleys of the financial landscape. And importantly, it's about using this knowledge to navigate the terrain more effectively. So what is market structure, you ask? Simply put, it's the way the market moves. It's the ebb and flow of prices, the peaks and troughs that form over time. And these movements aren't random. They follow certain patterns or trends which can be upward, downward, or sideways. Let's start with upward trends. This is when prices generally increase over time. Think of it as climbing a mountain. Each new peak is higher than the last, and even the dips or troughs along the way are higher than before. It's a sign that confidence and demand are strong, and often it's during these times that investors are most keen to buy. Next, we have downward trends. Here, the opposite is true. Prices fall over time like descending a mountain. Each new low is lower than the previous one, and even the peaks are lower than before. It's a sign of decreasing confidence and demand, and often, it's during these periods that investors become more cautious. Lastly, we have sideways trends. This is when prices fluctuate within a certain range but don't make significant moves up or down. It's like traversing a plain, where the terrain is relatively flat. This often occurs when the forces of supply and demand are evenly matched, creating a kind of stalemate between buyers and sellers. Each of these trends forms part of the market structure, and by understanding them, you can better anticipate potential shifts in the market and adjust your investment strategies accordingly. Whether you're climbing a mountain, descending a valley, or traversing a plain, knowing the direction of the trend can be a powerful tool in your investment toolbox. Understanding the market structure allows you to anticipate potential opportunities and risks in your investment journey. With these tools at your disposal, the stock market becomes less intimidating. It transforms from a chaotic scramble of numbers into a realm of opportunity, ripe for exploration. Now, you might be wondering, is it really worth dipping my toes into these waters? The answer is a resounding yes. Investing isn't just about potential financial gain, it's about the invaluable lessons you stand to learn, the patience you'll develop, and the empowerment that comes from taking control of your financial future. Every successful investor, from the Wall Street whiz to the self-made millionaire, started exactly where you are now, as a beginner. And they learned, just as you are learning, that investing is a journey, not a sprint. It takes time, patience, and a willingness to keep learning. Don't let the fear of making mistakes hold you back. Take that first step. Embrace the journey. Remember, the best time to start investing was yesterday. The next best time is now.